The year is 2026. The volatility of the early 2020s has transitioned into a new economic norm. Interest rates have stabilized, but the era of easy money is over. If you are starting today with $10,000, you cannot afford to be reckless, nor can you afford to be stagnant. This isn't just about preserving wealth, it's about strategic positioning in a transformed world. Today, we break down the definitive $10,000 model portfolio designed for the realities of 2026. With only $10,000, mistake mitigation is priority number one. Half of this portfolio, $5,000, forms the bedrock. In 2026, we aren't just looking at the S&P 500. We are looking at the Global Quality Index. We are allocating this capital to low-cost, diversified ETFs that focus on companies with high free cash flow and low debt. In an environment where borrowing costs remain moderate, cash-rich companies are the kings. This 50% ensures that even if the speculative sectors crash, your portfolio survives. By 2026, the hype phase of artificial intelligence has passed. We represent the deployment phase. We are allocating 3,000,30 of the portfolio specifically to the infrastructure and application of AI. We are not buying the speculative startups anymore. We are buying the pick and shovel plays. Think semiconductor manufacturing outside of traditional hubs and data center energy solutions. These are the companies powering the digital brain of the economy. This is where we chase double-digit growth. The financial rails have changed. We allocate $1,000, or 10%, to the asymmetric bet. By 2026, blockchain isn't about memecoins. It's about real-world assets (RUA). We are looking at tokenized real estate or government treasuries on-chain. This is high risk, high reward, but with a utility focus that didn't exist 5 years ago. This small slice of the pie gives us exposure to the potential 10x returns without risking the entire nest egg. The final $1,000 remains liquid. In 2026, cash is not trash. It is optionality. This 10% is split between high-yield savings and digital gold. It serves two purposes: an emergency brake during market corrections, and dry powder to deploy when high-quality assets go on sale. A portfolio without liquidity is a portfolio that cannot pivot. You have the allocation, but how do you deploy? You do not drop $10,000 on day one. We utilize a 6-month dollar-cost averaging strategy. We enter the market in tranches to smooth out the volatility of the 2026 election cycle aftermath. Discipline beats timing every single time. $10,000 in 2026 is just the seed. The allocation we built today: 50 quality, 30% tech infrastructure, 10% innovation, and 10% liquidity is designed to grow that seed into a forest. The market rewards patience, but it pays the highest dividends to those who have a plan. This is your blueprint. Now, go execute.